Welcome back, everybody. It's another episode of Fly on the Wall. Finance, I feel like we've been gone for a while, which is totally my fault. Margot's on it.
Holidays are crazy.
Oh, holidays are crazy, but we're
And end of
back.
the year stuff.
Yep. We're back. I hope to squeeze in one more episode before Christmas too. So as long as we have our stuff together, by we, I mean me, then we'll try to come to you one more time before Christmas. But topic for today is timely because we want to talk about the top 3 things that I recommend doing before the end of the year. So not like we all don't need something more added to our plate to hustle and get it done before the end of the year, right?
Yeah.
It's that time. Okay, 3 things. First is Roth conversions. Roth conversions have to be done by December 31st. Margot is making that face because she's in charge of deadlines.
Well, and that is the like I think people think about it like those last couple weeks and then it's actually too late.
Yeah. So
Yeah.
And if you're listening to this and you're like, shoot, I don't know that I have enough time, or I haven't even initiated this, or haven't even thought about it. These are the things that we want to start thinking about for next year. The reason Roth conversions typically are done in the 11th hour, so the last month, is because we want to know what the adjusted gross income is going to look like, so we can make sure that we're being intentional with the amount that we convert. So let's talk about this. First of all, what is a Roth conversion? All we're doing with a Roth conversion is converting a portion of your pre-tax dollars. So that is typically your traditional IRA, right? It's money that you've set aside. It's not yet been taxed. And so you might think, well, why in the heck would I go choose to have it taxed now? Because we definitely at some point in our lives want to have some tax diversification. We want to have a tax-free bucket of money. If we don't have any tax diversification, then on paper, it looks great, right? We look at our 401k, we look at our traditional IRA, it looks like we have all this money, but we know there's going to be a toll to pay ultimately to get that money in our pocket. Whereas with a Roth IRA or a Roth 401k, any Roth money, we've already paid the taxes. Now, forever, when that grows, that's growing tax deferred, and we're never paying any taxes when we withdraw from that, not even on the gains. So when we start thinking about, well, why would I want to do a conversion? Because we want to start building up that tax-free bucket of money. And if we think tax rates are going to be higher in the future, then we can make a case for, well, then I should probably do it now. I can't control when I do it. We've talked about this before, or I can't control that I have to do it, but I can control when I do it. So a couple of things to think about with conversions. If for some reason your income's lower this year, that would be a good time to do a Roth conversion. If you've had a loss of some sort that is going to bring your income down, might be a good year to do a conversion. If we are pretty squarely in one tax bracket and converting a chunk isn't going to bump us up into the next one, well, then we have to think about, we've got this year and next year before tax rates increase. And so maybe we want to be intentional with converting during that time period. Who shouldn't do one? Well, people that are already in retirement that are on Medicare, you have to be really careful about conversions increasing your income. That there's a little thing called IRMA, which is income related adjustment amount, that can bump you up into a higher bracket than for Medicare. So the reason why we do it at the end of the year is typically because we want to have a really good idea of what that adjusted gross income is. So we convert only enough that we don't bump ourselves into the next tax bracket. Now, what we can do at this time of year is something called chunking. And literally what we're doing is taking chunks, right? So we're looking at what can we do this year? We take that chunk and we convert it. And then January 1, we can turn around and do the remainder that we ultimately wanted to do, but we split it up into different tax years. So part of it is going for 2024, which is why we have that December 31st deadline. And part of it is going for 2025, which we would wait and do January 1. So even if you think you're too late for this year, if you're like Margot going, nobody sent me a bunch of stuff right before the deadline, then we need to chunk a part of it January 1.
I
So
always think about getting chunked in December is from all the holiday junk I eat, but that's a
that too.
good point to remember.
That too. That's another form of chunking this time of year.
Okay.
Okay, here's something that Margo, I know you and I have talked about with our kids, and something if you have a business. So normally this isn't a December 31st deadline. You can make a Roth contribution up to the tax filing deadline. So if you're just wanting to do like a kid's Roth account, don't worry, you don't have to scramble, you don't have to get that done. But if you have a business, so I'll give you an example. Brad and I have the real estate business. We own rental properties, so we can pay our kids for the work they do. Ashton mows lawns in the summer. He paints houses. Emma and Eva clean the rentals. So we pay them for that. But instead of just paying them for it and letting them go spend that money, we pay them, but we immediately take it and we make them do a Roth contribution for it. If you have a small business, though, the December 31st deadline is you have to get their payroll on the books by December 31st to show they had earned income in 2024. You can then make the contribution by April 15th, but you've got to show by the end of the year that you, as the small business owner, paid them their wage. So that's your deadline for kids' Roths.
So a parent couldn't just do that for chores. It would have to be a small business owner type situation.
Yeah. So with a kid's Roth, just with a contribution, kids can have earned income, multiple ways: babysitting, dog walking, they're mowing lawns. And really, you just need to be able to show some way of documenting that. So you could pay your kids for that. But if you're trying to take the tax deduction as a business owner, you've got to show that they had that earned income before December 31st. So you'd want to make sure that you've got that on the books. So that's the December 31st deadline. If that doesn't apply to you, kids' Roths are still one of my favorite things. I get asked all the time, well, what do you think I should do for kids? And traditionally people think like 529 plans, right? Educational funds, but they're so restrictive. And people like 529 plans because you take out the money tax-free. Well, you can do the exact same thing in a Roth for educational expenses. And I think one thing that people get confused on too is contributions in a Roth. You can always pull those out. You always have access to those. So even if you can't pull the interest out tax-free, you can always pull your contributions out. So it is another form of liquidity. So if you own a business and you have kids, get them on the payroll before the end of the year. Let that be their earned income. You take the deduction, they get the Roth contribution.
Yeah. And what a great, a lot of, I know you asked, like, at least you asked me, and so I know it's part of the thing, is like, what's most important to you is leaving a legacy. Is like, that's, I think a lot of people don't realize that's a great, easy way to leave your kids a legacy without it being, you're just constant, oh my gosh, if I don't have $1 million to hand them. But what if you could hand them a Roth? You didn't have to go crazy with it, but we know how important that time part of investing is.
Time. Yeah.
And
small deposit amount, but just time. Yeah.
Time.
Huge, especially for younger kids. I mean, the power of compounding is huge. So kids Roth, great for small business owners. The other thing, which we don't talk about a lot, but this works especially well for higher income earners, high net worth people, the mega backdoor Roth conversion, which is an after-tax contribution to your 401k. So let's say you've maxed out your 401k. I can't contribute anymore. I've maxed it out, but you still have funds that you want to do something with. Well, some advice might be, well, just put it into a brokerage account, investment account, have that. But we don't get any tax benefit from doing that. So a mega backdoor Roth is not something that's talked about that often. You have to make your 401k contributions by the end of the year, right? So it's different than like an IRA contributions. 401k contributions are by the end of the year. If you've already maxed out your 401k, you can do an after tax contribution, which allows you to deposit all the way up to the limit of 66,000 if you're younger than 50 for this year. So 66,000. So let's say I've maxed out at 23,000 and I'm a high income earner. I want to put some more money away. How do I get it in there? Do an after tax contribution. You can then turn around and do a Roth conversion on that money, a tax. So now you've got a tax free big
Nice.
chunk of money. That's called a
Uh-huh.
mega backdoor Roth, which is different than what we typically think about. And you do have to make that contribution to the 401k by the end of the year.
Okay.
So that's a cool one that I don't think it's talked
Yeah.
about very much.
I've never heard of
Well,
it.
quite frankly, we don't get asked a ton about like, how do I put $66,000 away into an
Yeah.
account, right? But we have business owners, we have people that need that tax deduction. We have some high income earners. And so for people that need that, that's a great additional tip, something that we can
Yeah.
do. And as a side, even if let's say you haven't maxed out your 401k, maybe you haven't maxed out your match, absolutely get your match in there. Like, that's free money, right? So if your company matches up to 6% and you've only contributed 4, if you have the ability to say, oops, I want to get that in there, I didn't do it, maybe I don't have enough time now for the payroll deduction to come through. It doesn't have to be a payroll deduction. You can physically write a check, hand it into your HR department, and they have to go put that into your 401k. So you can still get it in there. It doesn't matter where it comes from. But that would have to be a December 31st deadline. So another
Makes
little tip.
sense. Oh.
Something else that's been the bane of your existence lately. Do you know what I'm going to say? If I just say, like, what has been a huge pain in your butt the last couple of weeks? Something that we have to do for the end of the year.
RMDs.
RMDs.
Panic,
Ah,
anxiety, can't sleep at night.
yes. So the reason Margo can't sleep at night is because there's a pretty stiff penalty if we miss an RMD. It used to be worse. It used to be 50% of the amount that you
No
should have
way.
taken. Secure Act changed
Oh
it and
my
lowered it to
gosh.
25. 25 still pretty steep. Like, if you have a $10,000
Wow.
RMD that you were supposed to take and you miss it, that's a $2,500 penalty. So it's not as
That's
bad as it used to be, but it's certainly not
crazy.
good, right? Like, we don't
Yeah.
want to miss those. So required minimum distributions are now, if you are 73, you have to take your RMD by April 1st of the year following the year you turn 73. Okay. My advice is always just take it in the year you turn 73. There's some exceptions to the rule, right?
Please? Will you
But
please?
usually just take it in the year that you turn 73, just take it. Margo will like you better,
Yeah.
like me
I'll
better. If
hug
I'm
and
like,
kiss you.
Margo loves it when I'm like, yes, that applies, except for this person, this person, this
This
person, this
person,
person.
this person. And then put it on the and you got to remember in 3 months that they need to blah, blah. And then these are the things that keep me up at night.
Yes. So everybody rest assured, we're on it. We have reports, we have triple and quadruple checks on this, but your required minimum distribution, the IRS doesn't care where it comes from. So you don't have to worry about it per account. But if you have pre-tax money, qualified IRAs, you have to take it if you're over 73, or at least hopefully somebody's watching it and telling you if you fall into some weird loophole where you don't. Okay, here's something else that you can think about. If you're over 70 and you have IRA money, you can do what's called a qualified charitable distribution. Let's say you have RMDs due, and hey, I don't need that money. I really don't want to be taxed on that money. And you already give to your church, or there's an organization that you care about. You can reroute your RMD directly to that organization. That's a QCD. That has to be done by the end of the year, though. So you need to be on it. I've talked to a couple of clients that said, well, I wish I would have known, I already made my charitable contributions for the year, but that's something now they know they've got access to moving forward. So you have to be 70. If you're younger than 70, you can't do it, but you don't have to be 73 like you do for regular RMDs. So if you're 70 or older and you're like, yeah, I already make all these contributions and I'm just doing it with after tax dollars, get a tax break on that. Do a QCD, tell us, hey, this is something I want to set up, and we can set it up so that those deposits are bypassing you. You're never being taxed on it. It's going right from your IRA account to the charity of your choice. If you're older, you're satisfying your RMD and you didn't have to take the tax hit on it, which is pretty cool.
And I'm also going to throw in there, it's not necessarily the end of the year. It is, like for us this year, it is December 13th
Yeah.
because because they have to process
They
all
have
of this stuff
deadlines.
by the
Yeah.
end of the year. And when you look at, you're a lovely small business owner and have very personal connections, but then it's got to go through
Yep.
all these other places and they process. So December
It's not
13th
like just, hey, I
is
know Jamie and
D-Day.
Margot will get it done.
Right.
Sure,
We
we'll
can't.
submit it for you, but we don't have control over how quickly Schwab or whomever actually custodies
Yeah.
the money, and they're getting an influx. So they'll have deadlines. Now, sometimes we can work magic. Sometimes we can get exceptions. Have I gotten some on the last day of the month? Occasionally, but it is painful. It is stressful. Like, don't fall into that. So
Yeah.
a little pre-planning goes a long way. And
Yeah.
again, if you're listening and you're like, dang, I wish I would have known that. We know it now for next year. But let's make sure we take it. Okay, inherited IRAs. There's so much confusion over inherited IRAs. The IRS has actually waived the penalty for the last 4 years because people cannot get their stuff together. And by people, I mean companies,
Yeah.
not all of you individually. Nobody can agree on the verbiage and their interpretation of the IRS rule. And it changed from I used to be able to spread this tax liability over my life. Now it's only 10 years. But if the IRA owner was, the deceased IRA owner was our RMD age when they passed, or were they not? All of those little nuances make a difference on when you have to take it. So the IRS has just said, forget it. We're just going to waive it. So for the, what is 21, 22, 23, now in 2024, they have waived the requirement that inherited IRA owners have to take a distribution. Now, I am still, for the most part, recommending and putting the requests in for my inherited IRA owners. Why? Well, because if you split it up a little bit each year, you don't have this monster tax bill at the end that is for sure going to skyrocket you into the next tax bracket. So typically my recommendation is chip away at that a little bit each year and don't just try to do it all at once or over just a couple of years. But technically, if you have an inherited IRA, once again, you do not have to take it because everybody is so confused. The IRS has said, well, we're not going to penalize anybody because everybody's so confused on what they're supposed to do that we're waiving it again. So we'll see what happens with that moving forward.
Yeah.
But you got to love it.
They
Gotta love it when the IRS is just like,
That's what I mean,
forget
you
it, too
said
much
company's
confusion.
fault, but clearly the IRS is also having issues. I mean, what's that? You do that in your presentation. I can't remember like how many pages the tax code used to be compared, or words or something, and it's just insane.
That's crazy.
Keep it simple.
That's not possible. That's not possible.
Yeah.
Okay, tip number 3. So we talked about Roth conversions done by the end of the year. We talked about RMDs and who has to take them. I touched on this a little bit with your 401k contributions, and if you haven't reached your max, but also be thinking about your flex spending account, the FSAs. So if you are employed, you probably have some benefits like this, and a lot of people have either an HSA or an FSA. They are different. FSA is a use it or lose it. So I think you can contribute $3,200 this year as an individual, but you have to turn in your receipts by the end of the year. Like, you have to use that money or it's gone. You don't get it back. So you're making a face. Does that mean you forgot, or?
I totally did. I'm so angry because now when I log in, it was from I mean, you know how it's been a couple bad years where I just haven't been in, and now I have a $650 balance staring at me, and I literally emailed them, if you're taking my money, just take it away and don't let me look at it anymore, because I just get angry when I look at it.
Yeah, I don't want to see
yours
it
now. I don't want to see that I just gave you $650.
That's right. Don't be Margot. Don't lose it. So use it or lose it on FSAs. HSAs are different. It's not a use it or lose it. In fact, we recommend with HSAs, you not use it if at all possible, because that's like having another tax-free bucket of money that you can use later. it just continues to grow. And you can use that later for medical expenses. And then when you reach a certain age, you can use them for any expenses. So HSA is different. It also doesn't have the same deadline, but flex spending account does have the December 31st deadline. You are going to lose it if you don't use it. So take the next couple of weeks, find those receipts, send them in, get your reimbursements for that. We don't like missing out on free money. And with the 401k,
really
just as a
bad.
reminder, at least make sure, if at all possible, you contribute it up to your match. Let's say your employer matches 4%. You put in 4%, they put in 4%. Instantly, you have 100% return, right? So free money, don't miss out on that. If at all possible, check to see, did I at least contribute up to my match? And if you didn't, you don't have to say, oh, well, shoot, I only have one more pay period before the end of the year. That's not enough to get it. You can write a check. So if at all possible, they don't care where that money came from. You can show you have had enough earned income. They'll sort that out. Just get the money in there. So big three, as far as Roth conversions go, you can get a benchmark on this yourself. Look at your AGI. You can Google it. So what was your adjusted gross income and where does that fall in the tax bracket you're in? The biggest jumps are going to be like, if you're in the 12% tax bracket, we don't really want to bump you up to the 22% tax bracket, right? 22 to 24, you got a pretty big window in there. Maybe it's not that big a deal. And so you could do some chunking right now over the next couple of years while we're in lower tax brackets. We also typically don't like going from like the 24, 32, I think is the next one. 28, 32, maybe. Anyway, there's a big, you can Google it, right? So look at your AGI, see where the next tax bracket is, get an idea in your mind of, okay, if I wanted to convert some now before the end of the year versus some after the end of the year, how much could I do before I bump myself into that next tax bracket? And then talk to your tax advisor, talk to your financial advisor, make sure you've got a plan for that. For RMDs, make sure somebody's watching it. Somebody like Margot. Somebody who is going to lay awake at night, staring at the ceiling and emailing every day to be like, I triple check.
I was going to say, you have to be more annoyed with how many times I'm like, okay, but what about? No, they're fine, Margot. But what about? You just be glad I don't do it at 3:00 in the morning when I wake up in a cold sweat about
when you
it.
think about it. So make sure somebody is watching it. Companies that hold your money, you would think that they would be like, oh, well, if you have to take it, let me make sure you know you have to take it, or let me automatically distribute it. They do not. So they will have your end of year balance. Your RMD for 2024, for example, is based on your end of year 2023 balance. Doesn't matter how many accounts you have. It just matters your total qualified, which is your pre-tax dollars. How much do you have? There is a table. It's based on your age, and they give you a divisor. You do a little calculation. That's how much you have to take. Why do we have to do it? Because the IRS eventually says you've enjoyed tax deferral long enough, but we now want our money, and they make you start taking it out so they can tax you. And then the 401k, the match, the FSA, HSA, if you have it, make sure you're taking advantage of all those things. That's all free money, and we don't want to lose that.
So long as you submit your receipts and keep a hold of it.
So long as you submit your receipts. And if you do not and you forget, put your request in for them to remove the balance online so that you don't have to look at it and be sad that it's not your money anymore. Our tips for today.
Tip. Okay. And you're from your new office today for the first time.
The wall's not very exciting, although my chair is pretty cool, right?
It is.
Chair's pretty cool. Cowhide desk, which came from Sister Bojangles there in town, which I love. You can't see the front of it, but it also is very cool. And we don't really have anything on the walls yet, so that's not too exciting. But we hope that you can all come and see us. We're going to do an open house, and everybody can come in and check out the space. And yeah, we're excited to be in the new office. It's fun.
Awesome. Good deal.
All right. Okay. Well, if anybody has any questions,
Christmas to all.
Yep.
I guess we'll be back one more time.
We're going to try. I mean, that's all we can say, right? We'll
sing carols next time.
You might sing carols.
Okay.
I will not sing carols so that people come back. If these are topics that you're interested in, call us, email us, message us, however you want to get to us. We're always happy to answer any questions that you have, talk through specific scenarios that you think may apply to you, that is what we're here for. So thanks for joining us again, and we'll see you next time.
See ya.
All matters discussed during this show are for informational purposes only. Opinions expressed are solely those of Iron Horse Financial Services and staff. All topics covered are believed to be from reliable sources. However, Iron Horse Financial Services makes no representations as to its accuracy or completeness. This commercial shall in no way be construed as a solicitation to sell securities or advisory services to residents of any other state other than Kansas or otherwise permitted. Topics should be discussed with your financial advisor prior to implementation. Advisory services offered through Iron Horse Financial Services, a registered investment advisor in the state of Kansas. Insurance products and services are offered through Iron Horse Retirement, an affiliated company. Iron Horse Financial Services and Iron Horse Retirement are not affiliated with or endorsed by the Social Security Administration or any other government agency.